This is Made for More Living with Johnny Jennings. Online at madeformorerealty.com.
So we are back with Jana with Asset Preservation Incorporated. And we were just talking previously before the break about like the number one thing that you commonly see being people coming to you after the property closes. It's like, hey, I can't help you. It's already closed, right?
Yeah.
But you said there's one other thing on the break. You were sharing there's one other thing where it's like, oh my gosh, I wish people knew this before they before they began the process.
Yeah. So sometimes we get calls after the fact, and it's hard to help someone if they probably should have done some more preparation before exchanging. And that is determining who the tax owner of the property is.
Which sounds simple.
It sounds simple,
Yeah.
but we see a lot of issues in this environment because, this is a tax strategy. So it's paramount to determine who is the tax owner on the property that's getting ready to be relinquished, because it's not an exchange if it's one tax owner selling and a different tax owner ends up buying the replacement property. That's not an exchange, right? So we want to drill down and figure out who is the tax owner of this property, because that is the exchanger. And so if, for example, the wife owns a property sole and separate from her husband, then she is the tax owner on title to this property. And so she's the exchanger. So she would be selling the relinquished property and she would then be buying the replacement property. Or if the tax owner is an LLC, a regarded LLC that's filing its own tax return, it's issuing a K-1 to the members of that LLC, then that LLC is actually the owner, the tax owner of the property. And so the LLC is the one selling, the LLC is the one buying. And so it's really important to be consistent. And what will happen sometimes is people will not realize how critical that piece is. And so they will already be in contract on their sale and they'll be in contract on a replacement. And then we'll look at the contracts and they won't be consistent on the tax ownership.
Got it.
Or they potentially are a member of a partnership and they have the impression that they can break away from their partner and they can exchange and the partner can exchange separately. But when in fact, they're really held together in one partnership and the property is owned by that partnership. So the partnership should be selling and the partnership should be buying the replacement property.
So if everybody's in agreement, it's fine, right? If everybody that owns the property is in agreement on what's happening, that's fine. But it's where like, oh no, I want to go do something a little bit different or I want to add somebody on. That's where it starts getting
messy. And so
it's like a kid. You can't split up the kid. Right.
Without some good tax or legal guidance, right?
Okay.
And so that's where preparation is key, because if people are partners and they do intend to separate and they want to go their separate ways, either a marital separation, a divorce, or a partnership separation, there are ways of unwinding these things, but it's, you don't want to try to unwind those things during the process of a 1031 exchange. Yeah. All of these things take preparation, and they should be meeting their tax and legal advisors well in advance of considering an exchange, because if they do want to separate, they need to be able to season this property in a new tax format well before they do a 1031 exchange. And so at API, we don't give tax or legal advice. That's not our role. Our role is to be the qualified intermediary accommodating the exchange itself. But when we see the red flags, we'll certainly encourage them to go and talk to their tax and legal advisors so that they can get the proper guidance and plan ahead for a successful exchange.
Got it. So thing one, make sure that you don't close before talking to Asset Preservation Incorporated.
Correct.
And then the second thing is make sure that you contact them early in the process. Earlier the better.
Yes.
So that way they know who the owner is and they can advise you on what your options are.
Right. And if you're the realtor helping somebody shop for a replacement property, make sure you look at the tax ownership of what they're getting ready to sell and know that it's a critical piece of the exchange to keep that consistent. So whoever the tax owner is on the sale needs to be the tax owner on the purchase in order for it to be an exchange.
Well, that right there would have been a phenomenal show. Just those two things. But there's more. So I was unaware about 1031 tax deferred strategy. But I was unaware that there are other options within that tax deferral strategy. I don't know if I'm saying it correctly, but DSTs, Delaware Statutory Trusts, are technically a a 1031 exchange?
So they are a replacement option that qualifies for 1031 exchange.
Got it.
Yep. So exactly. So what a DST or a Delaware Statutory Trust is, that is fractional ownership in institutional quality real estate. So the investors are fractional owners within that trust format, and the trust is holding a piece of real estate or sometimes multiple pieces of real estate. And the reason that we see people doing that, and I would say they are growing in popularity, and I would say that the reason that is the case is that there are a lot of aging investors out there that have real estate in their portfolios.
Yep.
I would say, a good portion of the investment real estate are in the hands of the baby boomers, right? They've retired, trillions. Yeah. They've retired from their day jobs, right? And now they're looking at trying to retire from their property management or landlording jobs as well. And so they're kind of looking for exit plans. So, as a result, there are some passive real estate options that do qualify for 1031 exchange so that those aging investors can still take advantage of tax deferral through 1031, but instead of reinvesting in yet another property that they'll have to actively manage, they can look at either semi-passive investments or fully passive investments. So a semi-passive investment might be an example of maybe buying an office building with a triple net lease so that maybe they still have liability, right? And some involvement and potentially some cash injections going forward, but there's some separation because the tenants are responsible for the bulk of the expenses. So that's a semi-passive kind of position in real estate that would qualify for 1031 exchange.
Way more passive than dealing with vacancies.
More passive than, yes, if you're, throwing the hammer at the place and you're paying for all the repairs and managing all the tenants, right? So that's kind of the next step, that's semi-passive. But if somebody wants to go fully passive, then a Delaware Statutory Trust is a fully passive option for 1031 exchangers. And then there's also something called the 721 upREIT, which does also qualify for 1031 exchange. So both of them are completely passive. There's no managerial responsibilities, but you're also relinquishing control, right?
Yeah.
Because if you are actively managing real estate, then you have control over that real estate. You can decide when it's sold. You can go over and switch it up. You're choosing the tenants, every time it's turned over. And so there's control, but then there's also responsibility. Whereas in going into a Delaware Statutory Trust or a 721 upREIT, you're relinquishing control. You don't get to decide when those assets are sold or how they're managed. You're completely passive, but then there's also no cash calls. There's no injections of more money, right? Or capital calls, as some people say. And then there's also no managerial responsibilities whatsoever. So we do see a lot of aging investors going that route.
So if somebody was thinking about, hey, I want a 1031, maybe put it into a DST or 721 upREIT, we've talked multiple times about the tax, how it's the tax deferral strategy. How does somebody exit this? What's the end game in all this?
Yeah. Okay. So let me kind of give you paint the picture a little bit more. So say I'm an aging investor and I have a duplex, right, in Sacramento, and I am tired of the tenants, the toilets, the drama, whatever, right? I want to go on a cruise and not get a phone call that a toilet's backed up, right?
Exactly.
And so I'm looking to kind of exit from that, but if I just cash out of my duplex, then I'm on the hook for the capital gains tax and the depreciation recapture tax, right? The alternative would be to do a 1031 exchange. So you would engage with us at API, we'd set up that exchange. And then if you're thinking, okay, I don't want to reinvest in something that's got managerial responsibilities, then the exchanger would go sit down with a financial advisor that has access to Delaware Statutory Trust and 721 upREIT, because you do have to go with or meet with a securities license, FINRA regulated, individual, what they call a registered representative, that has access to these type of replacement properties. Because API, we don't sell any of these things. We're product agnostic. We don't care what the exchangers reinvest in.
Intermediary.
Okay? We're an intermediary. That's our job. We're just the third party holding the funds in between and drafting the documents and, kind of watching the timelines. But if someone wants to go the route of securitized real estate, they do need to engage with the proper people to get access to those types of investments. And they need to do their own research on, who those parties are and what their track records are and all of that. That's not our role. We don't advise on reinvestment. We don't give an opinion about what's a good investment. That's really between the exchanger and whomever they're using, either a realtor, a commercial broker, or a financial advisor, right, to figure out what to reinvest in.
Let's say they bought that duplex, right? And now they're saying, hey, should I 1031 it into another duplex? Should I put it, when does the deferral stop?
Okay.
Yeah.
So when does the deferral stop? So depending on which avenue you're taking, right? So one avenue might be if you go the route of the Delaware Statutory Trust, at some point that Delaware Statutory Trust, that property in that trust will be sold, okay, because those have a shelf life to them. So those investors will be told at the point of investment, we intend, this is the sponsor company talking, we intend to hold this piece of real estate in this trust for 5 to 8 years, for example. And then whenever it is a good point of sale, they'll be contacting all those investors and saying, we are selling this asset. Are you going to set up another exchange to defer again?
Yep, keep it going.
Or are you going to cash out? Let us know what your plan is, right? And so we call those full cycle events where the DST is coming full cycle, it's being sold, and then the investor gets to decide, are they deferring again or are they cashing out? So they have an option, right, at that full cycle event. Now, if the DST is going the route of a 721 upREIT, that's a different story, okay? That is where the DST, initially, that exchanger goes from their duplex through the exchange into a DST, but that DST has a different exit plan. That DST is actually, the asset is going to be pulled into a REIT through the 721 tax code, which is also a tax deferral strategy. And that means that investor goes from being a fractional owner in that Delaware Statutory Trust, and now they get converted into an operating unit holder within a greater REIT.
Got it.
And so then they are liquid effectively. However, when they access those shares, they're probably going to be realizing some taxation, so they want to talk to their tax advisor about what the implications of that would be.
Yep.
But that person can never exchange again because now they are holding operating units in a REIT, and that's not an exchangeable asset. So that's a different type of investment. Now, the question that you asked was, when does a deferral stop? Well, in our world, we say swap till you drop. Okay? Exchange, die, right? Defer, die. And right? I know, it's a high price to pay. Death, right? But it is really a strategy because a lot of investors are focused on that step up in basis that gets achieved at the date of death, so that their heirs are receiving those assets at the date of death valuation. And so that is really, so if you work it right, the deferral can, make it all the way till the point of death, and then it's, that tax slate is like wiped clean, right?
So if somebody passes and they're in a DST, the heirs then...
They still get the step up in basis because it's still real estate, right? It's just you're owning fractional ownership in a large piece of real estate instead of something that maybe you wholly own, right?
So it's 100 people owning $100 million, a property valued at $100 million, right? So you didn't have to put, qualify for the full $100 million. You just put your million in.
Exactly.
Yeah. And you're part owner, right? Not shareholder like a traditional.
Exactly.
Yeah.
Yes. Yep.
Got it. So the strategy is, what was it? Till you drop?
Swap till you drop.
Swap till you drop. And then that way your heirs don't have the burden of the deferred taxes. But if at some point you need access to those funds, then you're going to be taxed on them.
Correct. Yeah.
Well, this was a nutrient-dense show. Thank you so much for being on today. If anybody wants to reach out to you again, it's apiexchange.com.
You got it.
That's the website. What are some other ways?
You can also call our headquarters office, which is in Roseville, California, at 1-800-282-1031.
1031, love it.
Yep. Or send me an email, Jana, Jana, at apiexchange.com.
Wonderful. And you guys cover all 50?
All 50 states. So we are a national qualified intermediary. So our headquarters happens to be in Roseville, California. We're a 35-year-old business. So we're one of the oldest exchange companies in the nation.
Wow.
But we also have a hub in the East Coast on Long Island in New York. And then we have many satellites about the country of reps that are kind of out in the field teaching on 1031 exchange. So if anyone has an organization that they're looking at having a speaker, we do a lot of public speaking on, to groups of CPAs, tax attorneys, real estate firms, commercial brokerages, just really trying to get the word out on how to use this tax strategy, how people can build their wealth in real estate, leveraging this tax deferral.
Yeah. I love it. Well, thank you so much for being on the show today. Look forward to having you back soon.
All right. Thank you so much. Appreciate it.
Oh, life is complicated, right? That's why our good friend Johnny Jennings wants to make things easy, simple when it comes to selling your home. Listen to this. He's going to give you at least 3 cash offers on your home in as-is condition, which means no staging, open houses, organizing, no costly repairs. Just again, 3 cash offers on your home in as-is condition. It's simple, it's easy, it's quick. All you got to do is Google Johnny Jennings with Made for More Realty. Again, Google Johnny Jennings with Made for More Realty and get more for your home.